Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for September 20th, 2024. We've got Rooster in the studio. We have a bunch of slides to go through, but before that, top three things, which are Quad 3, rates, and the VIX. So starting off with Quad 3, obviously we sort of saw this play out in the last couple of days, but Quad 4 leads to dovish, which we had in September, leads to dovish policy, to US dollar down, and then all things priced in the dollar go up, which by the way is also inflationary. They all love the quad shift, and you can see the inverse correlation between strength and this morning with S&P approaching gold level strength with a 30-day correlation of for S&P 500 negative 0.77, gold negative 0.88. So dollar down, assets priced in dollars up. It's kind of that simple. And yesterday was, in a sense, a good way to get paid for some of the more stuff on the margin with that. Number two is rates. Obviously, a nice pop in bond yields. And Keith and I had talked about this earlier in the week, but basically this idea that a lot of the cut was already priced in, and we certainly saw that for a day or two. We'll see if it continues from there. I think our guess is probably not. But nice pop in bond yields to Capital on yesterday. Buy bonds and their Quad 3 equity bond proxies when they're on sale yesterday. So XLP, XLU, XLRE. The Hedgeye Treasury Bond Index, or the MOVE Index, got smashed for almost a 600 basis point drop down to MOVE 92. That's actually very bullish for these asset classes. We like to buy them when volatility is lower. Number two, VIX. So we're heading into the biggest quarterly options expiration ever, which is kind of crazy to think about, but that's happening. They smashed the top end of the risk range of the VIX, our vol signal yesterday, all the way down to 19.99. As our friends at Tier 1 Alpha like to say, a hedge pot barely boils, and that's what's happening coming out of the Fed cut. Short-dated calendar vol got crushed from 25 to 15 this morning, so obviously a lot going on. We had a couple days of some interesting moves, but it's probably back to sort of where we're at.
Yep.
I forgot to say this, but we're actually running near max invested in our global macro asset allocation and portfolio solutions. So I think we have about 34 positions and pretty much fully invested.
Yeah. I mean, there's a lot going on, and a lot going on with the rate cut, especially. It kind of shows a lot of the cards because our model is really right. It's growth inflation to front run the policy,
exactly.
So. And because the policy tells you where everything's going to go. We're going to get into that, but yesterday there was a great recording with the Tier 1 Alpha guys and Keith, so I definitely recommend checking that out. And in that spirit, we're going to start off with the Tier 1 Alpha data and where we are today. I'll show you a little bit how we use it. We're currently on this first slide in positive gamma, so that's that chart on the left, and then the chart on the right just showing you in how much positive gamma we're in. So we're pretty positive, and really what that means is that there's not a lot of chasing going on. It's really just people are going to not going to see these really large moves. Essentially, is all it means. So that's nice. And we go to the next slide on the short-dated calendar vol. So that's all the way down today at 15. Remember, that came from 25 before the Fed meeting, so now down to 15. And as you have the OPEX in the S&P 500 today, and then the VIX option expiration is the 25th. So as those two both expire, you could actually see this curve even get below this 14 to 13 level as well. But I think even more importantly than that, is also while everybody's maybe super positive, maybe it's time to bring down the expectations a little bit, because Monday you have manufacturing PMI and services PMI for the U.S. Right? Part of Quad 3, September is the Quad 4, right? And part of this Quad 3 is decelerating growth. Is growth decelerating? So manufacturing services PMI, just because the Fed cut by 50 basis points, it's not going to change the fact that these could be negative numbers.
Or decelerations.
Decelerations and or contractionary, most likely contractionary.
That will be, contractionary, which is below 50, and that will be September data as well.
Yeah,
so
and which is our worst month too. So could be something definitely look out for. Maybe you get an opportunity to buy some of the things you like on that day, and or you might just see something. On Thursday, you have initial jobless claims in durable goods. The durable goods is again more of a growth number. And then on Friday, you get the PC price index. So that's what's going to happen next week. So next is actually a decently heavy week in terms of what's going on. And you can also see, just based on the short-dated vol, people aren't really hedged for them that much. So definitely something to watch out for there. On the next slide, we have what his favorite charts is this 1 month realized volatility on the left versus the 3 month realized volatility. So the big thing is when that blue line, which is the 1 month realized volatility, goes below the red line, that typically signals that vol control funds, the chart on the right, start to buy. It's kind of interesting is that even though the blue line is below the red line, you actually haven't seen this really large buying yet from the vol control funds. So there's definitely still a good amount of buying left for them to do, which again on the flow side would be very bullish for things like the S&P 500. So that's definitely something to look out for. And good. And if we go to the next slide, I know we have a lot of questions on basically countries. I did this maybe one show ago where I showed you the countries have signals that are matching the quads. You can go back to that. I literally gave you the quads and their growth rates. But if we go to the next slide here, I give you the performance of all these countries. Now, I know you can probably not see it, but I definitely recommend going back to this. And how I would use this is all the way on the right, you have the US dollar correlations on the 15-day, 30-day, 90-day, and 120-day. Basically find those negative correlations, because what we're really almost not calling for, but are noticing is with the Fed's current policy, which is a very dovish policy, especially compared to other central banks, it's going to devalue the dollar. And when you're devaluing the dollar over an extended period, basically dollar goes down. All these things with negative correlations are going to be the ones that are most likely to go up. And just in terms of where we've been positioned, right? We mentioned portfolio solutions. A lot of it was in the APAC region, and so you have, and that's where we've seen some of the best returns on the 3 month basis. Like Philippines is up 23%, Thailand's up 23%, Indonesia's up 23%, Malaysia's 19%, Argentina is one that we don't have, that's 28%, and then Europe's a little bit further, not behind, they're just not seeing the same as the APAC region in our emerging markets. The highest one in Europe is actually Spain currently, and they're up 10%. So that's something to look out for, and I just call it like hunting down the negative dollar correlations. Like when they do have drops, they haven't, that's where you'll see Keith allocating to as well. On the next slide, right, so that's the country side. Now just looking at the actual S&P 500 side, the US, everybody loves the US. We're just looking here at the sales growth and the earnings growth on, I guess, the GSIP level 1 index, right? And so again, if you're in growth decelerating modes, that's quad 3, right? You want to allocate to the things where they actually have growth accelerating, right? And so really where we're seeing a lot of growth accelerating is in the utilities side and the real estate side, and we've been heavily allocated to both the utilities and real estate side as well. And then ones that we're not allocated to right now is the materials and industrial side as well. And then if we go to the next slide, here, same thing. I just gave you every ETF and the subsectors, the performance, and all their correlations. So again, the way I look at this is I go to the right, the US dollar correlations, and I find all the red. Some of the big ones are actually like small cap utilities are doing quite well. Your home builders, which we've been talking about as well, have been doing quite well as gold miners, which we don't currently have a position in, but also been doing pretty well. So that's what I have on that side. One thing we did do actually, we actually do now after every Fed meeting, we do like a little Rooster Reacts, and so now we had a lot of slides from that.
What was your reaction?
Reaction was basically, my generation is not in a good spot in terms of if we want to ever buy a house. That's basically what it was.
Well, I'm going to do a little segue here on that, because I'm actually in the middle of selling my apartment.
Okay.
Somebody came to me unsolicited, got a good price.
Yeah.
I didn't really plan for what was next, which, I probably should have planned more because I have a daughter. but I ended up renting a place, which, by the way, around here it was hard to rent what I thought was a nice place too. There was just not a lot of inventory.
Yep.
But the housing market, especially in our microcosm, is just kind of crazy. Like,
Yes.
there's nothing what I would consider reasonable. I don't think my standards are that high for probably less than $1 million in the right area, right school district. And I make a decent amount of money, but like, think about your generation, right? Like, where are you buying, especially if you're in the Northeast, right? Like,
It is, so just got married, so doing the same type of thing, right?
Yeah.
Which is like, are there houses out there? Is this even a worthy investment in our area?
Well, then there's that. Is it a worthy investment? You on one hand, you like the dynamic that supply and demand is tight, and then rates are coming down, so that should inflate housing. You would think even higher, but at what point are we just pricing people out of it all?
I honestly think we're like basically at that point.
Yeah.
Because we've been looking at houses too, right? You're completely right. The 1 million mark is almost not even enough.
Yeah.
Like, you almost have to get to the 2 million, 1.7, 1.8 million range to get something that's like not a shack is literally what I'm talking about. I'm not even saying like multiple acres or anything. I'm just like a house, right? And then if you look at inventory below 500,000 in our area, there's one house.
That's crazy.
It's so like everything is just it's very hard. And then as well, like, rents are supposed to go up too during this type of time period as well. So
I think this all is a tailwind to inflation that's not going to go away, obviously. Right?
Exactly.
And rates going down probably only accelerates that. So
exactly. That's what we really talked about in the Rooster Reacts, and these next like 9 to 10 slides, we really go into what's about to happen for everybody, and this exact dilemma, which is a really big one, I would say. And so we'll go to slide 8 to start it off, and I'm sure we'll talk a lot more about this throughout the show. So basically all that happened yesterday was the Fed cut by 50 basis points, right? So you can see what that looks like on the chart and where rates were, right? And obviously then that goes and affects stuff like mortgage rates, right? And when mortgage rates go down, housing prices and a lot of prices start to go up, okay? But the kind of the more, not even interesting is the Fed also, give me 1 second here. So the Fed also, they gave a forecast for where they believe rates will be by the end of the year. So by the end of the year, they're expecting that rates to be at 4.4%. So what that is essentially 2 more cuts by the end of the year is what the Fed is telling the market, like literally said yesterday. And then by 2025, they're expecting rates to be at 3.4%. So that's 6 cuts by the end of 2025. So kind of the big thing and why the market reacts is the first cut is never the last cut. And so just imagine that 5% is all the way down by towards 3.4% by the end of the year. Mortgage rates will follow, and all rate sensitive things follow. So houses and literally everything. And so that's not good. And basically what all that the Fed was saying yesterday was essentially everything is fine, economy is fine, inflation, it's going to go down to 2%, which we think is very wrong. And that basically we just cut because rates were too high, but everything was fine. So, and that's where the issue starts to come into play, because if everything's fine and you're cutting, that means there's excess demand when you cut. And so that just drives up demand, and when you drive up demand, you drive up prices eventually. And so, and on the inflation forecast, they have inflation just going down towards 2%, essentially, like on the slow meander. And that's where we have a problem with the Fed, and that's where we really disagree. And so I know we tend to be pretty negative on the Fed, or maybe if you're new to us, you might say these guys are really negative on the Fed. Let me tell you why we're negative on the Fed first, okay? So this chart is one of my favorite charts. So that blue line is the amount of mentions of the word transitory, okay? So what happened in 2020 to 2021 was the Fed was calling inflation transitory, which basically meant that inflation, it's going up, but like, don't worry, it's gonna come back down like in the next couple of months, basically don't worry about it at all, right? And so that was their big keyword, was the word transitory. So you can watch when they're calling inflation transitory. They were calling inflation transitory on March of 2021 when inflation was 2.6%. Okay, then they started increasing the amount they were calling it things transitory. In June of 2021, inflation was now at 5.4%. Didn't stop there. December 2021, that's when there was peak amount of mentions of transitory. That's inflation at 7%. And the last little spike was in 2022, where inflation hit 8.3%. So essentially, the entire way up of when inflation was going up in 2021, our Fed, 2021, 2022, our Fed was calling inflation transitory, and it's not going to be a problem. Now, we go to the next slide, we wake up, it's 2024, we wake up, inflation is now up 21% since the pandemic, okay, for the people. So when people are saying, I'm hurt by inflation, this is why, right? Inflation's up a lot. And really the problem is that while this was all going on, if we go to the next slide, why did this happen? I know they say it's supply shocks, and yeah, that did have a small part, but there's also a huge money printing issue. So on this slide, you can see, basically you see M2, which is the amount of money in your economy. So in February of 2021, the amount of money in your economy went to an all-time high. It went up 27% year over year. Now, if you remember on the last chart, it was March of 2021 where they started to call things transitory. So while M2 is going to an all-time high, so the amount of money in the US is going to an all-time high, that's when they start their transitory narrative.
And we know that when money comes in, then there's a lag and an add-on effect. So really you're calling it transitory just as the money that is peaking coming in, but then you have the ongoing, you should know you'll have the ongoing effects of that money having come in.
Exactly. So like really their job is kind of to track the amount of money in the system, and that'll tell them where inflation is going. And so the fact that they're calling it transitory at peak M2 is kind of like, well, what are you really modeling here? Yeah. And then the bad part is that all the way down for M2, it comes down by the end of their narrative of basically the transitory. You had M2 still up 16.8%.
Yeah.
So that's still, if you went historically, that would be around all-time high M2 growth, right? Yeah. So it came down on a year-over-year basis, but it was still at close to all-time highs. And so that's what was happening there. And if you go to the next slide, so maybe you can say, oh, the Fed didn't know that, and that everybody has an impact on M2. Well, here's their balance sheet, right? And so their balance sheet is the Fed directly controls, okay? And you can see basically what happened during the pandemic. So June 2020, the Fed's balance sheet was at about 7.2 trillion. They grew their balance sheet all the way to 4/13/2022 by about basically 2 trillion, 1.8 trillion. So that's them putting new money directly into the market. And again, you go back to all those peaks in transitory. So they're calling it transitory while they're injecting the system with money.
Yeah.
That's a pretty red flag that they, like on this inflation, I don't really trust them at all, because you can't be injecting money and then saying prices are going to go down. It's just not how the flow of money works. And so that's why we are the way we are with this current Fed on inflation. And if we go to the next slide, here's what's going to happen. And this is one of the most important slides, right? So we had the July. So on the left, you're basically seeing the releases of consumer prices in line with the next Fed meetings, okay? On the right, so you have the Fed meeting on July 30th, and I put the 3 inflation reports that they would have going into that July meeting. It was a 3.4, 3.3, 3.0, okay? This September meeting just happened 2 days ago. Those numbers are the inflation reports they had. A 3.0, 2.9, 2.5, okay? Decelerations.
Yeah.
So now we get into the next meeting, which is November, right? And so in the November meeting, their next 3 inflation reports are going to be a 2.9, a 2.5, and what we're projecting to be maybe a little bit below 2.5 to flat, Nothing really crazy going on. So that's going to give them, they're going to be A-okay to cut rates further from there, right?
Yep.
Nothing's going to be that bad. The problem is once you get into December, after you get that last inflation report that we're saying is going to be about flat, you're going to have two large accelerations in inflation from there. So that's going to be almost the bottom in terms of your inflation. And so what's going to happen is that's when everybody's going to kind of wake up and be like, oh, maybe we can't cut as these 6 times in the next year. We'll see if the Fed continues to cut, but that's about when the market's going to wake up to this reality. They'll be on their high horse
where you should see an acceleration in CPI.
When you're seeing that acceleration in CPI, people are going to have to be like, oh wait, maybe inflation isn't coming down towards 2%, and we have that acceleration going basically into the first part of next year. So we have it going towards 3%, but I think really as we get more numbers, that'll update, and we'll see how it updates. It's a long way away. So that's pretty important. So that's where we have inflation going, which I would say is much more accurate than where the Fed is telling you it's going to go. Okay, on this next slide. So one of the big things I've seen or seen people say is, okay, a Fed rate cut, it means that we're in a recession. Okay, and which is fine. So when you're looking at this chart, basically the gray bars are recessions. You can kind of see when the Fed starts cutting, it means there's a recession. Okay, but that's not always true. That was true in 2000, 08, and 2020. It was not true in 2018, and you were seeing almost all-time high, those all-time highs in the S&P in 2018. And if we just go to our nowcast here on this next slide, this is our quarter-over-quarter growth projections for growth. And right, in order for us to be in a recession, you need 2 quarters to be negative in a row. Okay, we currently have GDP going to 2%. The consensus is 1.7, and the Fed's at 2.47%. Those numbers are nowhere close to 0 and or negative, right? So this whole, this imminent recession, I mean, the whole market has to be unbelievably wrong for that to happen. And so really what all this says is that we're not going into this recession, and we're cutting rates, which again is going to, like we were talking about before,
eventually have an inflationary impact.
It's going to have that inflationary impact for us. And then if we go to the next slide, I just put our year-over-year numbers for GDP because it's a lot easier to see the cycle. When you're looking at year-over-year, quarter-over-quarter is bumpy, you don't see cycles. But all that's really happened is we went from a GDP of about 3.15 towards now about 2.4%. So it was a decelerating economy, right? Growth is decelerating, absolutely, we agree. And all we have is for GDP to go towards 2%. Again, not 0, not negative, it's not like the world's crashing here, is really the big point with this. And that's, again, why this is what's actually happened in the market on the next slide, which is the devaluation of the dollar, which we've been calling out on the macro show. We're on the macro show. We've been calling out on the call if you've been listening to Josh Steiner on this, and we've been making in our positions for a couple of weeks now in Portfolio Solutions. So what's happened is we've seen a 5% drop in our purchasing power, the U.S. purchasing power, within the last 1.5 months, okay? So, which is a large drop for the dollar. But why this happens is essentially you have it's basically, I almost think of it as almost like this voting system of, do people believe what the current narrative is in the U.S., right? Which is them saying inflation's going down to 2% and we're going to cut rates. Basically, the market's saying what's going to happen is your currency is going to keep going down if this is the way you continue. And then how else we can see this is on the next slide. You can see this basically shows the U.S. and all the other world central banks. And basically in the first column, it just says next meeting. You can see the UK did not raise rates. Norway is not raising rates. Australia is not raising rates. All these different economies, what they're basically saying is we have inflation coming actually back up. We're not going to cut rates because it's kind of risky to be cutting rates in this. while the U.S. is going gung-ho, being the person on the block that's cutting rates the most. And what that basically does is people are like, okay, dollar down, these other currencies go up. So that's why we have a British pound position. It's one of our largest positions, right? Yeah. And if you go all the way to meeting number 5, which is on the other side, you have the U.S. cutting 5.5 times, and you have all these other. We're the highest one on the block, except for Canada. So
we're the most dovish, which if we, number one, if we follow through, that'll be bad for the dollar. But even if people believe they're going to follow through, that'll be bad for the dollar.
Exactly. And that's what we're seeing in the dollar currently, and that's how we're basically positioning as well. And we saw that with all the prices in APAC. APAC loves this devaluation because their main way they trade is with the dollar, so it helps their export economies and so forth. And if we go to this next slide here, is basically we're just looking at home prices versus the dollar, which is what we were talking about before. So I put green bars over when the dollar is decelerating a lot. You can see the black line is home prices. Home prices go up. Okay, so and it's really more just the price of all hard assets go up. It's just asset prices in general, right? So like S&P 500 is also an asset. It's not a hard asset, but it's an asset. Rent, like we were talking about as well. And if we go to the last slide, so this is where like the real kind of big concern comes in. This is home prices versus mortgage rates, right? So as the Fed cuts, and as they're telling you they're going to cut, mortgage rates will go down. What typically happens when mortgage rates go down, housing prices go up. I guess that's up. Yeah. Okay. Housing prices since 2020 are already up 53%. Yeah. That's a lot. That's a lot. But that was with rates rising. They were going up that much. So now you had rates rising, but now you're having a situation where both the dollar's going down and mortgage rates are going down. That's very bullish for housing prices. Yeah. So what that basically means is you can see this reacceleration in housing prices. I almost feel like it's almost like this, like kind of like a launch point. Like we were really high before with non-favorable housing market. Now it's favorable, dollar down, rates down. Prices just go up even higher. Yep. So therefore, I will not be buying a house or able to buy a house.
Keep renting. Maybe it's a better financial situation.
It could be. I've ran the numbers a lot, and it's basically what I found. You just look at the long history is that while housing prices do go up, so is the market going up, and typically the market goes up more than your house price goes up. So if you're putting that money away into like an account, and it's also growing while the housing price is growing, hopefully you're at least keeping pace, if not outperforming, hopefully. Yep. So that was all the slides I had.
Okay, we got a couple minutes here. First question, I guess a bit of what you're doing now. Like what. I know you use your AI. You look at our at portfolio solutions. Yeah. What ETFs do you like at the moment?
The biggest ones I like are
excuse me.
Are essentially what I'm doing is I'm pairing. Bless you.
Keith would be mad at me right now.
Really?
He's sneezing.
Oh wow! I just smile. Anyway, the biggest ones that I'm looking at what's going to happen basically on Monday, right? Because market obviously is figured out this whole rate situation. They know it's going to happen. Dollar is going to happen. And over the past couple of days, you saw what the market, like the potential of what this is. Yeah. But people are too hot, right? Like I'm not trying to buy at the top of the range. I'm just kind of looking at the short-dated vol curve and saying, okay, people are not hedged for Monday, and we're in a decelerating growth, and maybe people will start to freak out on that, maybe not. So basically, I'm looking at a lot of actually like semiconductor exposure, tech exposure. I know a lot of our tech exposures went bullish trend. Semiconductors haven't. So tech would be XLK, semiconductors, SHOCs. That one has a large NVIDIA. But anyway, so that's what I'm looking at there. And then as well as trying to get into the emerging markets is the big one. They have literally not gone down for the past 3 weeks. Like every single day in APAC has been up. So looking at that, so all the ones I mentioned before are on that list. Israel is one of them, and then starting to look at looking at energy. So like uranium plays, sugar plays. AI just went bullish on uranium and it's been bullish on sugar for almost a 20% gain right now in sugar. But we'll wait for that, like a little bit of a drawback there.
Okay, sounds good. All right, we're going to wrap it up there. Thanks everybody for tuning in. I know we did a bit of a deep dive on the Fed, but I think it's important to understand the context and also where we might be going from here. Have a great weekend.